Welcome to the Chesapeake Capital Market Observations Call. Today is Thursday, February the 1st. I'm your host, Eric Jefferson. To kick things off here, have a few quick words from our legal team. With that, we can go ahead, dive right in. I want to start by recapping the Fed committee meeting yesterday. Heard from Chairman Jerome Powell. No surprises there. The committee voted unanimously to keep rates where they were. Then, in his comments afterwards, acknowledged both the progress bringing inflation down as well as the continued strength in the labor market. He did hint at cuts likely to come later this year, although squashed the probability that would take place in March, barring any meaningful softening with respect to the economic outlook. Now, my sense is they don't necessarily need more data on inflation. That is trending lower. That is starting to reach their targets. However, they're also in no rush to do so. Again, we talked about the strength of the labor market, some softening leading indicators, but based on where it is today, just think they're not in any rush. Likely will exercise some patience unless overall conditions do deteriorate. We did see a interesting market reaction. Stocks sold off sharply. Again, don't think anybody was expecting rate cuts yesterday. I think that catalyst really more to do with the fact that investors were hopeful March cuts may be coming. That again, all but got pushed back. Interestingly enough, with some of the Magnificent Seven, those are the mega cap names that benefited from a lot of enthusiasm around AI. Yesterday's meeting overlapped with earnings season for a handful of those names. Both Google and Microsoft down fairly sharply after delivering what were perfectly fine results. I think the key takeaway there, they weren't necessarily the euphoric figures some investors were hoping for or maybe have come to expect. You saw that represented in some fairly sharp high single-digit sell-offs. Now, this month's Asking for a Friend, we touch on a topic that recently took place end of January. S&P 500 hit a new all-time high, traded just shy of 4,900. This is now well over the 11th time this has happened going back to the indice's inception. On average, it happens about once every 2 weeks, so a fairly common trait. That being said, we think about the mantra buy low, sell high. I have received a handful of questions on whether now is a time to divest equity holdings given the record high prices. Go on to offer some context as well. The S&P 500 index not mean reverting to a particular price, rather to a annual growth rate. Again, we think as the economy, as companies continue to grow, not surprisingly, would expect to see that price upward sloping as well. Now, on a non-investment note, just a friendly reminder, this is a leap year, so February will feature 29 days as opposed to the standard 28. Just a reminder, update your watches, keep an eye on the calendars as well. That's all for this week. As always, happy to answer any questions. If we don't connect, have a great rest of the week. Take care.